In this video, we're going to discuss journal entries related to sales returns and allowances, as well as potential adjusting journal entries that we may need to make if we've granted our customers rights to return merchandise. We can grant customers the right of return for a variety of reasons, perhaps dissatisfaction with a product as an inducement to encourage them to make a purchase. A company returning the product will receive any of the following combination of consideration: a full or partial refund of any consideration that they paid, a credit that can be applied against amounts owed or that might be owed later to the seller, or another product in exchange. So we'll go ahead and take a look at the journal entries related to sales returns and allowances, as well as year-end adjusting journal entries that we're likely to have to make. The journal entries associated with sales returns and allowances, as well as the adjusting entries for estimated sales returns and allowances, will involve both parts of our original sales entry. That is, we're going to have to record a reduction in net sales and cost of goods sold. An example would be, we will, of course, debit sales returns and allowances. And if it were an actual sales return, we, of course, would credit cash or credit accounts receivable. For estimated allowances at year end, we will credit accounts payable or more likely some other related liability account. At the same time, a sales return always involves a debit to inventory and a credit to cost of goods sold. In this case, we will debit estimated inventory returns since we haven't actually received the inventory yet because our sales return hasn't been made, but we will still nonetheless credit cost of goods sold. So you can see our journal entries involve reductions to both net sales and a reduction in our expenses or costs. Let's go ahead and take a look at an example. In our example, we'll begin by recording journal entries related to the sale and a sale return and allowance. And then also we will record journal entries required at the end of an accounting period for estimated sales returns and allowances. We're told that on March 10th, the steel company sold tool sets to Bar Hardware for cash. Customers are allowed to return unused tools within 60 days of purchase, and Steel estimates that the cost of recovering the products will be immaterial, and the returned tool sets can be resold at a profit. On March 25th, 2020, Bar returned some tool sets, and information concerning the sale and return are given below. We're also going to prepare journal entries for the quarter ending March 31st. So we've sold 200 tool sets at a price of $50 a piece. They've cost us $30 a piece. And we estimate total returns to be 10 sets. And on March 25th, Bar returns 6 sets. So let's go ahead and record the journal entries associated with the sale of the tool sets. We're selling 10,000 units at $50 a piece. Make that 200 tool sets at $50 a piece. So we debit cash for $10,000, and of course we credit sales revenue for $10,000. We need to record the cost of sales portion of this journal entry, and each tool set cost us $30, so 30 times 600 is cost of goods sold of 30 times 200 gives us cost of goods sold of $6,000, and we credit inventory for $6,000. We're next told that on March 25th, that Bar Company returned 6 tool sets. Let's record the journal entries for the return of the tool sets on March 25th. We will debit sales returns and allowances. Again, sales returns and allowances are a contra sales account for $300. That's the 6 tool sets at $50 a tool set. And we will credit accounts payable since the sale was in cash, and we're going to have to pay Bar back. We also need to make our journal entries for inventory. 6 sets at $30 a piece. We can restore $180 to inventory, and quite often instead of inventory we will use returned inventory to separately identify those types of returns. And of course we will credit cost of goods sold for $180. And again, the debit to inventory returns rather than inventory is because we want to separately track the amount of inventory that has been returned, and quite often that inventory might not be able to be sold as new. Think of all the refurbished items you see sold on Amazon.com for slightly lower prices. Those generally are merchandise that has been returned to Amazon and the cartons have been opened, so Amazon can no longer sell it as new merchandise. Finally, let's look at the adjusting entries that are going to be required on March 31st, 2020, when Steel prepares its financial statements. At this time, Steel believes that its original estimate of 10 total returns is correct, and so far, BAR has returned 6 tool sets, so we're still expecting returns of 4 additional tool sets. So we will debit sales returns and allowances for $200, that's the 4 sets at $50 a piece, and we will credit accounts payable for $200. And actually, we probably won't credit accounts payable, but rather some other generic liability account. We're going to want to reserve credits to accounts payables or transactions related to accounts payables for actual amounts we owe customers or we owe vendors. And we don't yet owe BAR the $200 because they have not yet returned the tool sets. We're just expecting the return. So we've recorded the sales return and accounts payable. We also need to hit the cost of goods sold side of our transaction. Once again, we will debit estimated inventory returns. And again, notice estimated inventory returns rather than actual inventory, because inventory represents an asset we have on hand. This is not an asset that is the same as inventories. It's sort of a make-believe asset set up to offset our make-believe accounts payable. But we debit estimated inventory returns for 120, and we will credit cost of goods sold for 120. So notice we have reduced sales by 120, and we have reduced the estimated or related cost by 120. We've reduced sales returns by 200 and estimated cost by 120. Let's go ahead and take a look at our income statement on March 31st as it relates solely to the sales transactions to BAR Corporation. We had reported sales revenues of $10,000, but we've recorded sales returns and allowances of $500. That was the 10 sets at $50 a set. That gives us net sales of $9,500. Our cost of sales would be $5,700. And again, that's the original $600 less the $300 allocated cost to the 10 sets we expect to be returned. That gives us a gross profit of $3,800, and our gross margin on the sales to BAR would be 38%.